Today I have 9 tips for you that will help you as a day trader to read the charts better, analyze the charts more effectively, prepare your trading days in the right way, and in general improve the quality of your trading, and so also hopefully to improve the performance of your trading. First, we have to take a look at how we use yesterday's high and low as a day trader, which is maybe one of the most important things that you can have on your charts. And the yesterday high and low is so important because it's a 100% objective tool or level on your charts. A lot of algos use it, a lot of automated strategies use it, many day traders use it in their discretionary and technical analysis. So it really works exceptionally well. And if you are on, for example, the 5-minute, you can use it on Forex, on commodities, this is gold, but also on crypto and stocks, indices. Yesterday's highs and low, or even the weekly highs and low, are very well respected levels. And what you often see is that here you can see we have yesterday's high in green, we have yesterday's low in red. And what you'll often see is that trends often end at yesterday's high or low. You can see during the day, the market was trending lower after we rejected previous yesterday's high. So yesterday's high was here. Then you can see we get the line here. And you can see the market try to trade above it. Early on during the day, the market failed to continue higher, push above the highs, eventually fell back inside below yesterday's high, and then continued or started the downtrend until the market reached here, the other side of yesterday's low. And that's where the trend of the day ended. So you can use it in many different ways. Look for rejection, and you can also use it for targets. You can also see that if you have a rejection very early on in a day, so you can see here's the new day, this is yesterday's low, the market tried to trade into it, rejected it 3 times, 1, 2, 3, and then the market shot up higher. Very nice break and retest pattern around here. After the rejection, I talked about dirty retests in previous video quite a bit, which is covered here. And you can see when the market comes close to yesterday's high, that's then a good indication or a good place to think about taking profits, because of course sometimes the market will break through it, but it's better to be safe than sorry. And if you have already ridden a good trade of the day, and if you have ridden the trend of the day, and this is often then a way to exit a trade. You can see this is the Indian rupee, so it works even on exotics. It's just a very important tool that you can use everywhere on your charts. We use it on the Euro US dollar, 5 minutes, so we have looked at gold, the rupee, and Euro US dollar, a Forex major pair. Here we see the rejection of yesterday's low once again. The market traded higher, made its way here. You can see this was a high yesterday. Then it didn't make it all the way to today's high. And then you can see afterwards the market broke into another low, rejected it. This is a divergence here if you add, for example, the RSI. And then you can see the market shot up higher. And this was the end of this downtrend. Right after the yesterday high and low, we have to talk about the central pivot point, because it's a 100% objective tool or level on your charts that all the traders have, always at the exact same spot. And that's why it is so well respected and it works really well. And how do you use it? So for example, here we have the weekly pivot point, and during an uptrend you will see that the market trades above a weekly pivot point. When you have a pullback during an uptrend, you will often see that the market rejects those weekly pivot points, keeps trading higher, rejects them, keeps trading higher. And then if you see the flip, so the market goes from trading above it, retesting the weekly pivot point as support, to retesting it from underneath as resistance, that is often where you see that the trend is rolling over. And then you can see the market is trading below the pivot point, breaking above it, retesting it as support, and now trading higher. So the way the market tests the pivot points is going to help you determine the trend direction, and that is a very important tool. You can see here we are using the pivot point once again. This time we are using the daily pivot point, and you could use it in a very similar way as the yesterday's highs and low. You can see the market is trading into the pivot point. We are having a double top. The market is failing to break above the pivot point, trading below the last recent low, and then here the new downtrend emerges. The market trades into the next pivot point, gives you here a divergence, gives you a lower high, you have a nice support level here, a break in a retest pattern, and then the downtrend continues. So you can see overall the market is in a downtrend. It's testing all the pivot points from underneath here as well. And those tests and those fake outs of those pivot points can often be used for trend following, trend continuation entries, where you essentially trade those pullbacks into a pivot point, you look for weakness around it, and then you can approach it with a breakout, with a break and retest strategy. For a day trader, I would always also recommend to at least once a day check your daily candle and see what you have there. So here we are first on the higher time frame, the daily time frame. And what we see here is that, first of all, we see that the market is in a very strong downtrend. Here you can see we are having then an engulfing candlestick. And where is it happening? Very close to a previous supply area. So a lot of things are coming together. And this is then a good indication for a day trader to look for potential long entries on the lower time frames. Why? First of all, the engulfing candlestick is a very strong bullish signal. Second, it makes sense to look for a long after a strong market has been moving to the downside. So the longer a market moves to the downside, the higher the likelihood there is for a pullback. So this is the information you get from the daily time frame, and then we could go to a lower time frame. And here you can see this is what it looks like on the lower time frame. First of all, what we see is that the market is trading above the central pivot point, which is a bullish signal, which is great. It is agreeing with the higher time frame, but we don't see much else. So what we do now is wait a little bit longer. And you can see shortly after we get the new pivot point, the market is trading into the pivot point from above. And it seems like the market is retesting it as as support. Then you can see a little bit afterwards, we have another fake out. This is very important. I would always recommend to wait for a fake out. It takes a little bit more patience. However, if you see the market is actually breaking out of the pivot point and then turning back, that is a very good confluence factor that is showing you there was an attempt of the bearish side of the selling pressure. However, the bulls took over quickly. The price was driven back into a previous high. And now you have the trading plan on your hand that if the market breaks above this level, then you would look for a long. So what does it mean? We have our trading plan, which is long. It's agreeing with the higher time frame. Because we have the engulfing candle, we are looking for a pullback. On the lower time frame, we have the pivot point rejection. We see that the market is making higher lows already. And then on this breakout, we would have a higher high as well. So you can see how we are nicely stacking multiple confluence factors to arrive at a great trade idea. And this is what happens afterwards. The market broke it, retested this area, and then a new trend emerged right after the central pivot point rejection, and it is in line with the higher time frame. And if you trade in line with the higher time frame, usually you will see that your trades work out much better, much faster, much smoother. Obviously nothing works 100%, but this is a great starting point for your analysis. Tip number 4, look at the moving average position. So what we have here is the 1 hour time frame, and we are using the 50 SMA. And generally what you want to see is, first of all, is the market above or below a certain moving average, because that gives you generally a sense of direction. A lot of professional traders, especially the one that I always think about is Marty Schwartz, who has his own book, Pitbull Champion Trader. He was also featured in the Market Wizards. He won at least one trading championship. He is often referring to his moving average rule. So he would just filter out the market is above a moving average. That would give him a long bias. It doesn't mean that you automatically go long, but it gives you a long bias. And if the market is short, you would look for shorting opportunities on the lower time frames. So this is the first clue. Second, how far is the market away from the moving average? Is the market very close to it? Then we are often just looking at the start of a trend, a moderately strong trend. However, if the market gets very far away, especially within a short time frame, we are talking about an overextended market. And those moves are very often unsustainable, because the further away the market gets, the more overbought it is. And it's far away from the average price. And what this means is that the market is often returning to the average. So the further away the market is, the more overheated the situation is. And I would be very cautious of looking for trades that would drive the price further away. I would more look for reversal trades back into the moving average. The third signal is then the break and retest. Once the market is breaking on the other side of the moving average after trading above it for a long time, here we see we have the break below it, and then here we have the retest. The market is trying to break back above it, but it is being rejected and driving lower. So this is then often signaling the starting point for the bearish trend, and this is a very important piece of information. In this example, we are using the moving average tunnel. So those are two 60-period moving averages. One is applied to the high and one to the low, and then you get this tunnel. And what this is used for are pullback trades. So what you often see is the market is pulling back into this tunnel, and then as the market touches such a tunnel, you would then, for example, go to a lower time frame, and then you would look for moves away from the tunnel. So in this case, when the market trades into the tunnel from above, then you would look for longs away from this here as well. And if the market comes into the tunnel from underneath, then you would look for shorting opportunities. So this could be used as a pullback approach on your lower time frame or on your higher time frame. Next, let's talk about the ATR and how it helps us to understand volatility and also price potential. So here we're using the ATR 14 period, and what this tells you is how much volatility is there in the market. So ATR stands for average true range. So it shows you on average how much has the price fluctuated, moved in the past. And you can see that here on those spikes, when we look here what has happened, you can see that previously there were a lot of wicks. The candles are very large in general compared to here where you have small candles, almost no wicks. And you can see the ATR is very low. So the ATR helps you to understand what market situation are you currently in. Is there a lot of uncertainty? Is there a lot of volatility? And you would use this for your stops, for example. So when your ATR is very high, you would generally use stops that are a little bit larger because there's a higher likelihood that the price will just fluctuate around a lot. And in order to avoid premature stop runs, you could place your stop loss a little bit further away using the ATR as a guidance. Another very interesting way is here I added the moving average to your ATR. If you want to learn how to set this up in TradingView, let me know in the comments below. I can make a tutorial on that. And the moving average is the blue line. So what this means is that when the ATR, the red line, is above the blue moving average, it shows you that now the ATR or the volatility is higher than what you usually have. So very often during trending phases, you will see that the market is breaking above a moving average. And at the turning points of a trend, that's usually where the ATR is highest. And then once the market falls back below here, the moving average, then you can see the market is entering a range. So it's a very, very interesting way of looking at your ATR using the moving average as well. The ATR can be used in a different way. So the ATR, what it does is it can also tell you how much did the price move yesterday. So for example, the ATR will show you yesterday the trend moved for 50 pips, and on average for the last 2 weeks the market moved on average for maybe 50 pips a day. And you can use the ATR to look at, okay, did we today already reach our average true range? So if today the market has already moved from the low to the high 50 pips, and that's what the market did yesterday and the day before and the day before that, then there's not a high likelihood that today we suddenly can expect 100 pips. Of course, sometimes this is true, but on general, what happened yesterday and the day before and the day before that is very likely to repeat in a similar, not in the exact way, but in a similar way. So here you can see those boxes are ATR-based exhaustion zones. There's an indicator for exhaustion zones that we developed. There is a link below in the video description if you want to learn more about it. And what you can often see is that as the market moves into those exhaustion zones, that's often where you see the trend end, because the exhaustion zones analyze and show you how much can you really expect on average today for the price. And when you see the market is moving into an exhaustion zone, then slowly it should be time to think about an exit, and you don't want to be as aggressive anymore because the market has already done what it has done in the past. So this is a very effective way and interesting way of using the ATR in another way. When you look at a chart, always ask you, are we in a pattern or are we in a trending phase? Why is that so important? Let's find out. And what you see here is that I marked accumulation and distribution phases. And between those phases, that's where the market moves. So this is a very common thing in Forex, in stocks. We are here on commodities. And what you often see is that the market is going sideways for a while, and then it is breaking out. So in a distribution, it is followed by a lower breakout, and then this is where you have the big potential. And why is this so important? It's important to understand, are we currently trading sideways, or have we already left and exited such a sideways pattern? The big problem that many traders have is that they get caught up in those sideways phases, and there's not a lot of profit potential in those sideways phases, because you can see the market is just very erratically moving up or down. The price is not moving a lot, and there's not much money to be made, and it's very easy to lose a lot of money because the price is just shooting up and down and there's no clear trend here. However, if you see that the market is exiting and breaking out of such a distribution or accumulation phase, then that's where the market moves. That's where the big money is made. That's where you have the trends. So it's very important to always ask yourself, are we still trading sideways? And if the answer is yes, then just sit on your hands and don't do anything. Wait for the breakout, wait for the break and retest. But if you can just make sure that you don't trade sideways phases, you may already improve your performance quite a bit. And this is a very, very common pattern and a very common repetitive theme, no matter what time frame we are, whether we are on a 5 minute, whether we are on the 4 hour, the daily, the weekly, you will see that the market is following this rhythm. We have sideways phases followed by a breakout trend, sideways phase, breakout trend, sideways phase, breakout, sideways breakout. So it's very, very important to understand that this is how the market moves. This is the rhythm of the market, and then you can use it in your advantage. You can even use it in a Renko chart. And by the way, I have not done any Renkos on this channel. So if you're interested in a Renko strategy, let me also know in the comments below. And a Renko also very nicely can show you, are we making double tops, triple tops? Are we turning around? Are we making higher lows, lower lows? And then a Renko chart, the strength of a Renko chart is that it really helps you nicely capture trends. You can see trends just look so nice in a Renko chart, and that's the strength and the advantage of a Renko. So let me know if you are interested in maybe learning more about a Renko approach. So we have talked a lot about charts now, for how to read a chart, how to prepare your day, what to look for. But obviously we also have to ask ourselves before we start our trading day, what is our mental position? What is our mental situation? Are we really ready to trade at a high maximum level? Or are there problems and maybe we should not trade today, or at least be a little bit more cautious? So in Edgewonk, which is the trading journal that we developed, and the link to edgewonk.com is in the video description below, you can track very nicely your mental state. And you can attach a tag, for example, to your trades. And then you can see very nicely what is your performance on the trades where you did exercise, where you took care of yourselves, where you were in a good mood. And you can compare that to those trades where you were sleeping bad, where you were stressed out. Maybe there was an argument in your family, in your job, with your friends. Maybe you were drinking last night. Maybe you overall felt very hectic and aroused. And what you will often see is that if you really take care of yourself and if you trade at a high maximum mental level, then also it will be reflected in your account and in your trading performance. Trading is a very, very high performance activity, and you need to make sure that you're taking care of yourself and that you only trade when you really feel ready. So this is a very interesting way of finding out how is this correlating between your mental situation, your mood, your stress level, and your trading performance. Next, you also want to make sure that you always check the news for that day. So on forexfactory.com, you always get the news calendar for that day. And then you can very nicely see on which currency is there news coming out. Is it medium, low, or high impact news? And what time is it coming out? So for example, if you're trading the Euro US dollar, and then at 3:30 p.m. there is German flash manufacturing PMI coming out. It is classified as a high impact news. So it is likely that you will see a big move on your markets, on your Euro pairs. And that is often a good situation to just sit out Don't take a new trade before 3:30 p.m. because the market may just spike around and very easily hit your stop loss. Also, what you often see is that the spread is widening during those news events. And if you're in a profitable trade, maybe think about taking an exit. Don't risk giving back the profits when the news is coming out. So it's very important to be aware, especially as a day trader, to know what is the news on that day. Also, I would always recommend before you start your trading day, look at your last 5 trades because it can give you an early heads up on what type of market you're in, or also is there anything that you should be aware about. For example, if you're in a losing streak and your last 5 trades were all losses, you are more likely to either be very scared, you are not able to pull the trigger as easily, or other traders may push it too much. They may risk too much because they want to go back to break even. So they may take more risk to just recover the losses. And that's very important to understand before you start your trading day so that you are not becoming victim of bad trading decisions. So look at your last 5 trades in EdgeWonk and look at, first of all, the outcome, but also look at the tilt meter. The tilt meter shows you, have you respected your rules on your last 5 trades? In this case, you can see a green tilt meter means yes, you did respect the rules, and a red tilt meter means you didn't. And if you, for example, would see there are a lot of red tilt meters, that should be a very big red flag because it shows you that on your last trades, you are not really paying attention, you are breaking your rules, you are sloppy, you are not disciplined enough, and that should then be an indication for you to maybe step back a little bit, redo your trading plan, refocus, and look at other ways so you can improve your trading performance. If you see that your tilt meter is green, that's good because you have respected your rules, and then you can go ahead and keep your trading quality at a very high level. So that's it, all of my 9 tips for day traders. Let me know what you think about this video. Which is your favorite? Where do you see yourself having maybe a little bit more work to do? And if you have another tip that I should add, let me also know in the comments.